DEWA is the exclusive provider of electricity and water services across the entire Emirate of Dubai, the utility monopoly that powers, cools, and hydrates one of the world's fastest growing cities. For investors, DEWA offers exposure to one of the most defensively structured businesses on the Dubai financial market, backed by essential service revenues and a very generous dividend policy. So, is DEWA a stock worth tracking? Let's break it down. Dubai Electricity and Water Authority (PJSC) was created in 1992 through the merger of the Dubai Electricity Company and the Dubai Water Department. It listed on the Dubai financial market in April 2022 under the ticker symbol DEWA. At the time, its IPO attracted 85 billion US dollars of demand and was 37 times oversubscribed, one of the most successful listings in UAE history. One important detail for investors is that the Dubai Investment Fund, the government of Dubai's investment vehicle, holds approximately 82% of the company, with the remaining 18% held as free float. That level of anchor ownership matters because it links DEWA's long-term direction directly to Dubai's own economic development strategy. The business is structured around three core activities: the generation, transmission, and distribution of electricity and desalinated water. On top of that, DEWA operates a growing portfolio of subsidiaries. It owns 80% of Empower, the world's largest district cooling provider by connected capacity. It also owns My Dubai, the bottled water business, along with Digital DEWA, Etihad Esco for energy efficiency, and several other companies. It runs the Mohammed bin Rashid Al Maktoum Solar Park, the world's largest single-site solar park, targeting 5,000 megawatt of capacity by 2030. Now, let's look at the numbers. According to DEWA's official FY 2025 results, consolidated revenue reached a record 32.84 billion dirhams, an increase of 6% year-on-year. EBITDA rose to a record 17.37 billion dirhams. Operating profit reached 10.99 billion dirhams. Net profit tax climbed 25.66% to 9.09 billion dirhams. Those results were driven by rising demand for electricity, water, and cooling services across Dubai, combined with continued cost discipline and operational efficiency. Power generation reached 62.21 terawatt hours, up 5.10%. Clean power generation jumped 52% to 10.10 terawatt hours, accounting for 16.23% of total generation and crossing the 10 terawatt mark for the first time in DEWA's history. Desalinated water demand reached a record 161.5 billion imperial gallons. Customer accounts grew to 1.327 million, up 4.48%. Capex for the year was 11.72 billion dirhams, primarily directed towards renewable energy capacity, desalination plants, and transmission and distribution networks. For dividend-focused investors, this is where DEWA really stands out. Under its dividend policy, DEWA commits to a minimum annual dividend of 6.2 billion dirhams for the first 5 years starting October 2022, paid semi-annually in April and October. Net profit after tax covers this dividend by approximately 1.46 times, meaning the dividend is well supported by earnings. The dividend for the second half of 2025, 3.1 billion dirhams, was distributed on April 20, 2026. The next dividend, another 3.1 billion dirhams for the first half of 2026, is expected in October, subject to approval. The first quarter of 2026 delivered an exceptional start to the year. According to DEWA's official Q1 2026 results announcement, consolidated revenue reached a record 6.45 billion dirhams. EBITDA rose 18% to 2.88 billion dirhams. Operating profit climbed 54% to 1.29 billion dirhams. Net profit surged nearly 90% year-on-year to 940 million dirhams. Cash from operations reached 3.89 billion dirhams. Clean energy accounted for 18.5% of total power generation, up from around 16% for the full year 2025. DEWA also commissioned Block A of the Hassan Seawater Reverse Osmosis Plant during the quarter, adding 60 million imperial gallons per day and taking total desalination capacity to 555 MIGD. There have also been two major strategic developments to track. First, in late 2025, DEWA acquired an additional 24% stake in Empower from Dubai Holding for 5.18 billion dirhams, increasing its ownership from 56% to 80% and consolidating all Dubai government energy related businesses under DEWA. Second, in mid 2026, DEWA launched DEWA International, a new subsidiary that will pursue energy and water infrastructure projects outside the UAE, positioning the group for global expansion. From an investor's perspective, there are 5 things to monitor closely. First, electricity and water demand growth as Dubai's population and economy expand. Second, execution against the 2030 targets of over 23 gigawatts installed capacity and 735 MIGD of desalinated water. Third, growth in clean energy share and the Mohammed bin Rashid Al Maktoum solar park build out. Fourth, the Empower contribution to consolidated earnings after the increased stake. And fifth, whether the 6.2 billion dirhams annual dividend continues after the initial 5-year commitment ends in 2027. DEWA is not a fast-growing tech stock. It is a regulated monopoly infrastructure business, essential service in nature, with predictable cash flows, expanding clean energy exposure, and one of the most generous dividend commitments on the DFM. So, is DEWA a stock worth tracking? Absolutely yes. The company has delivered record revenue, record profit, record clean energy generation, expanding capacity, and a well-covered dividend, all supported by monopoly rights across Dubai until 2072. But investors should still monitor capex intensity, dividend sustainability beyond 2027, execution of DEWA International, and valuation carefully. A monopoly utility is not automatically a buy at every price. This video is for educational and information purposes only. It is not investment advice or a recommendation to buy, sell, or hold any security. Please conduct your own research or consult a licensed financial advisor before making investment decisions.